So we've heard just how much the market environment has changed over the last year, and part of that change has been a welcome revival in value investing. We've seen this year just how, yet again, value equities have proved defensive in a very difficult marketplace. Can this continue? To answer this question, we've invited our next speaker, Patrick Meegan, who is a portfolio manager at Hotchkis Wiley, a value specialist based in Los Angeles. And again, we thank him very much for making the journey over to London to see us today. So Patrick has over 3 decades of experience in the industry, and he's managed money through difficult periods like the dot-com bust. And the question now is, are we in a similar period today, and what are the opportunities in value equities? And I'll invite Patrick on stage now to provide some answers to some of those questions. So, thank you, Patrick.
I wanted to say good morning and thank you for the opportunity to offer our firm's perspective on value investing in the current environment. Our firm, Hotchkis Wiley, has a 40-year history as a disciplined, high-conviction value manager. Value investors purchase shares of companies where the present value of their future cash flows exceeds the current share price. The investment decision is made after a detailed study of the company and the industry in which it operates, and a careful consideration of risk, which we define as permanent impairment of capital. Value investors focus on companies that trade at valuation discounts to broad market indices. Valuation discounts typically occur because a company's current financial results are below expectation, industry and/or company issues, specific issues have arisen, or the business is misunderstood. Growth investors focus on companies trading above broad market valuation levels because a company's prospects look very strong and are expected to grow more rapidly for longer. Growth stocks historically have traded at higher premium valuation multiples relative to value stocks. I'll refer to that phenomenon in this presentation as the growth valuation premium. But in many cases, the growth premium proves excessive and reverts down. This reversion occurs because additional investor enthusiasm often, but not always, wanes as a new business develops, competitors emerge, and the risk inherent in new industries, business models, and products become clearer over time. Value investing isn't better or worse than growth investing. In our view, they are complementary. Many of our clients pair us with disciplined, high-conviction growth managers to generate consistent alpha across market cycles. Value investors rely on mean reversion and historical financial information, while growth investors find mean reversion exceptions and innovators that create new industries or disrupt the competitive dynamic within existing industries. The presentation today focuses on 4 key points. First, value outperforms growth over time. Second, the growth valuation premium today is very wide. Third, banking, energy, and software stocks look particularly attractive in this current environment. And fourth, European stocks trade at a large discount to US stocks, albeit with elevated risk. Empirical and academic studies have consistently demonstrated that value stocks and small capitalization stocks outperform over time. This chart shows the 58-year annualized performance of growth and value stocks bifurcated into large and small market capitalizations. The data source is FAMA in French, the academics who first identified value in small cap growth market anomalies, and is among the longest value or investment specific data sets that are available. Value has outperformed growth by 170 basis points annualized for large caps and by 650 basis points annualized for small caps, again, based on the FAMA and French data. Value's outperformance has been attributed to many factors, but in our view, it's driven by investors' tendency to over-extrapolate recent business performance, informing their expectations about the future. This over-extrapolation, which is also called the recency bias in behavioral finance literature, fails to fully consider mean reversion, the economic principle that high returns attract competition, driving future returns down over time. In the long run, stock prices follow business fundamentals, including growth, margins, and return on invested capital. In the short term, however, stock prices ebb and flow with changing investor expectations about the future, which is ultimately unknowable. These short-term price fluctuations create investment opportunities for patient, long investment horizon value investors who determine a stock's intrinsic value after a comprehensive, independent study of the historical business performance metrics of the investment candidate, its peers, its suppliers, and its customers. The value investor's deep dive into a company more fully considers the impact of mean reversion on business fundamentals. Unfortunately, values outperformance is far from consistent. In fact, the 12-year period from the GFC through the COVID pandemic was value's longest underperforming period, causing many people to question the efficacy of value investing. This chart shows value rallies, periods where value outperformed by at least 10 percentage points. As you can see, the current value rally has lasted 21 months, 12 months shorter than the average value rally duration, with comparable cumulative outperformance. The current value rally began in October 2020 with the rollout of the COVID-19 vaccine, which dramatically changed investor expectations regarding the future. The COVID-19 lockdowns would end. Based on duration, the current value rally is 64% complete, which is meaningful but not necessarily compelling. But this analysis fails to consider the growth valuation premium, not only at the outset of the current value rally, but today. As detailed in the next couple of slides I'll go through, elevated growth valuation premium at both the beginning of the value rally and today provides evidence that the value rally, today's value rally, could look more like the tech bubble burst rally that you see, kind of the other long one highlighted there. Which lasted 84 months and delivered 177 percentage points of outperformance. In our opinion, the current value rally will last longer and provide more outperformance than the average because the compelling growth valuation premium at the outset of this cycle and where it is today. This slide, which is, can you guys, let's see. Okay, we're gonna have to do this one. There's lines on that slide. What it's designed to show is the growth valuation premium across 4 common valuation metrics using the MSCI growth and the MSCI value style indices. And let me see, we're gonna come down. The current value rally's growth premium starting point are consistent with those of the tech bubble rally. So on this chart here, if you were to look at it, you'd see on a price to trailing earnings basis, the premium of growth over value is about 100%, which is pretty consistent with what it was at the start of the tech telecom bubble burst rally. And then the second thing is that the distance, today it's at about 90. So you've basically gone from 100 to 90 today, and you still have 38 basis points, 48 basis points of valuation premia points to get back down to the median. And so the point that we're trying to make on this slide is no matter which metric that you use, all of these charts are very similar. And they show that the current value rally starting point is on par with the tech telecom bubble burst, and that there's still considerable vertical distance between where we are today and the median. Let's see how we do with the next one. This slide. Okay. This slide looks more closely at the valuation price to trailing earnings, that the growth valuation premium metric using price to trailing earnings. And what it's highlighting is the dispersion, the difference between the top and bottom growth premium valuation deciles over time. The top decile stocks are a proxy for high growth stocks, while the bottom decile stocks are proxies for deep value stocks. Note the similarities of the current valuation dispersion with that of the tech bubble burst rally, so back in 2000. Also note that the current growth valuation dispersion premium remains wide. It's currently in the 38th percentile relative to the 27-year data set. In our opinion, the current 38th percentile dispersion data point highlights that growth stocks remain richly valued relative to value stocks because of the persistently high investor expectations afforded to high growth stocks today relative to deep value stocks. The wide valuation dispersions add support to the assertion that the current value rally will continue and deliver more outperformance. Moving forward to the next slide, in the interest of time, and because I actually think this slide's a little out of order, I wish I would have done it differently as I was preparing for this, I'll touch on it briefly. European stocks trade at a material discount to US stocks and represent strong potential outperformance candidates going forward. So if the value rally is going to have legs on a global basis, Europe's going to have to be a driver of that. Europe obviously is undergoing a uniquely challenging political and economic period, the duration of outcome of which are unknowable at this time. While we're modestly overweight European stocks within our global value strategy, our exposures are centered on banks, defense, and telecom companies, and we have no utility exposure. So we're involved in European stocks, but given the uncertainty of, around the outcomes with the Russian war in Ukraine, it's really difficult to come in there and say, hey, let's buy an industrial company in Eastern Germany. Next slide. This slide, make sure we got everything there. This slide highlights the growth stock valuation premium during the COVID-19 pandemic period. And again, it's using the trailing PE valuation metric in the MSCI World Value and Growth Indices. This slide shows growth valuation premiums over the past 27 years, the black line going up and down. And it highlights 3 data points. The pre-COVID level, which was in the 15th percentile. December 31st, 2020, which was in the 1st percentile. And currently, it's in the 9th percentile. These 3 categories all fall in the lowest quintile of observations. One way to think about it is value is more attractive today relative to growth than it was at the outset of the COVID-19 pandemic. And today, the valuation data point, the most recent one, the June 30th one, remains within the same valuation quintile as the start of the tech bubble burst rally. And historically, low quintile growth stock premium valuation observations have resulted in value outperformance over the ensuing, in this chart we show it over the ensuing 36 months. So when you're in that quintile, which we clearly are today, history says you're poised for value to continue to outperform over the next 36 months. Take a look at the next one. This one, I think next I'd like to turn to where we're finding investment opportunities within the value universe. But before I get into that, I think some color on the current economic environment will help set the stage. This slide highlights the historic inflation and interest rates in the United States. Inflation today is running at 4-year highs, while both short and long-term interest rates have increased dramatically since the Federal Reserve pivoted to a hawkish monetary policy in January of this year in response to high inflation. Interest rates are reverting upward toward their historic levels in response to the curtailment of unprecedented monetary policy stimulus over the past 12 plus years, which coincides with value's longest underperformance period. The next slide shows in inflationary markets, energy and material sectors have historically outperformed as their revenues grow in line with inflation while their operating costs remain relatively fixed. These cyclical sectors provide an inflation hedge, if you will, relative to the broader market. Conversely, non-cyclical market sectors, including consumer staples, healthcare, utilities, and telecom, have historically underperformed during inflation periods because their ability to pass through inflation is less robust, while their cost structures are more input and labor cost intensive. Value benchmarks have higher exposure to these cyclical sectors, which should provide a tailwind for us going forward. In addition to the cyclical exposure tailwind, values, lower valuation level becomes more important in rising interest rate environments. Lower valuation multiples are shorter duration cash flow streams, which are less interest rate sensitive than higher valuation multiple cash flow streams. Rising interest rates have historically been a tailwind for value investors. In our opinion, banks provide the most interesting investment opportunity in the current rising inflation interest rate environment. We think banks are particularly attractive for 3 reasons. First, compelling valuation discounts relative to both the MSCI World and World Value Indices. A critical tenet in value investing is price matters, and banks have a provocative valuation starting point. Second, banks benefit from rising interest rates because higher rates enable net interest margins to expand as lending rates rise more rapidly than rates paid to depositors, which, by the way, are currently close to their floor level at 0. And then third, banks have significant excess capital, even taking into account the increased regulatory capital requirements in the wake of the GFC. This excess capital is currently being aggressively returned to shareholders. Should the global economy sink into recession, clearly a risk in this current environment, the excess capital can be redirected to fund credit losses. So the balance sheets are built for a recession that may happen. If it doesn't or the recession is shallow, you'd continue to see excess capital return to shareholders. And why don't we do this? Well, you know what? Let's do this. We'll go. I'll catch up. This next slide, I'd like to use Goldman Sachs as an example to reinforce my earlier assertion that value investors focus on long-term business fundamentals to take advantage of short-term pricing fluctuations. So our firm's detailed independent industry and company analysis ultimately centers around one estimate: normal earnings. We define normal earnings as the sustainable level of cash earnings a company can generate under equilibrium economic and competitive market conditions. The left-hand chart shows Goldman Sachs' historic asset, loan, and deposit growth over the past 7 years, with the first data point indexed to 100 for comparability. Note the consistent positive growth across each metric. The right-hand chart compares stock price movements on the left-hand axis and our Goldman Sachs normal earnings estimate on the right axis over the same time period. Observe the comparability of the changes in the 3 growth metrics on the left chart with the progression of our normal earnings estimate on the right chart. Normal earnings track long-term fundamental business drivers. That's the whole idea behind them. Now, if you compare the volatile stock price movements with our relatively stable changes in normal earnings, value investors take a long-term view of a company's business prospects, informing their normal earnings expectations, and seek to take advantage of stock price fluctuations caused by the broader market's focus on recent data points informing expectations about the future. Also notice the current wide disparity between our most recent normal earnings estimate, about $35, and the current share price, which I think is about $280 on the chart. The greater the disparity between the current share price and the normal earnings, the more attractive the investment opportunity becomes for value. So the greater this delta, the lower the normal earnings and the more attractive it is. And what we're trying to do is, here's Mr. Market in the short term going up and down based on fear and greed. And here is our the output of our research process, tracking the growth in earnings, normal earnings over time. And so we're guided by normal earnings in a market that's guided much more by the next data point. Okay, let me see here. Energy has been the best performing sector in the current value rally, outperforming the MSCI World Index by 80 points over the last year and a half. Notwithstanding the strong relative investment performance, energy stocks continue to trade at large discounts to both the MSCI value and overall world index. Above normal oil prices coupled with below normal drilling activity has produced significant free cash flow, which has been used to pay down debt and return capital to shareholders through dividends and share repurchases. We think energy companies represent a compelling investment opportunity for 3 reasons. First, favorable oil supply-demand dynamics should keep oil prices elevated even in the recession scenario. Second, disincentives to accelerate drilling encourages managements to continue returning free cash flow to shareholders. And third, energy stocks should act as an inflationary and geopolitical tension hedge in the current environment. The last area I wanted to look at from a valuation standpoint is software. Software companies trade at attractive valuation multiples relative to traditional recession-resistant sectors like staples and utilities, while offering higher growth rates and better balance sheets. We think software companies represent a compelling investment opportunity in the current environment for 3 reasons. First, they have stable, high free cash flow generating business models. Second, they offer higher growth rates versus staples and utilities, traditional safe havens in a recessionary environment, at better valuations. And third, software companies have a low commodity and labor cost inflation sensitivity. In effect, we're owning software companies in our clients' portfolios as a proxy for the defensiveness investors historically got from consumer staples. And then let me just see. The last slide here, this one's, well, at least we can see all the lines, that's good. But it's a little bit busy, but let me try to boil it down for you. Our global portfolios are overweight banks, energy, and software companies. This slide shows our global value strategies trailing and normal price to earnings ratios over the past 8 years and compares them with the MSCI value and growth benchmark. Note, the growth premium multiple remains wide and our portfolio trades at lower multiples than the MSCI World and Value indices, both on a trailing and normal earnings basis. Disciplined value investors focus on companies trading at valuation discounts relative to the broader market because we believe price paid is a critical determinant of investment return. And then I would also note here is, going back to consistency, in a world where the indexes are up and down and all, these are market cap weighted, our normal earnings, price to normal earnings multiple has remained relatively constant over the 8-year period. That's, in our opinion, that is us consistently doing our job of determining normal earnings and being conscientious about the multiple we're paying for normal earnings. And then just to wrap up on a summary slide, the last slide provides a summary of the key points I tried to make during this presentation. First, value is attractively priced relative to growth, despite the current rally. Second, I don't know if I did that or not, but we got this. We expect the current value rally to continue because of the provocative growth valuation premium remains wide today. And third, market volatility creates investment opportunity for active value and also growth managers. Thank you very much for your attention, and I look forward to answering your questions.